Hi, good morning. I'm Dan Moorhead from Pantera. We have the whole investment team here with me as well. Thanks for joining this call on our new blockchain fund launch. Um, we would love to answer everyone's questions. So if you have any questions, feel free to use the Q&A box. Our CFO and the investment team are all here to answer those questions. We'll answer them real time as we go. And if there are any of general interest, we'll answer them at the end. And we're happy to stay as long as people have questions. Many of you are already LPs in many of our funds, but for those of you new, just want to give you a bit of background on Pantera. I was formerly the head of trading and CFO at Tiger Management, and then founded Pantera in 2003. For a while, we managed $1 billion of very normal institutional investor money, but in 2011, I got interested in Bitcoin. And in 2013, we launched the first blockchain venture fund in the United States and the first cryptocurrency hedge fund. Since then, we've launched a handful of other firsts, which has been very good for those investors that wanted to have very specific exposure to one specific subset of the asset class, or for investors that could only do, say, venture or could only do highly liquid hedge funds. However, it's left us in a suboptimal position for those that just want to invest in blockchain as a concept. So we'll return to that in just one second. Here's a few stats on the firm as a whole. We're currently managing $5.5 billion across those 4 different strategies. We have invested in 75 different companies over the last 8 years and 54 early stage token projects, which are very similar to venture, but they're not equity, they're protocol tokens. We typically like to lead deals. We've led half of the deals that we've invested in, but we're always open to investing with other prominent generalist VCs who can add value in the other aspects of the venture space. There's a question that I always get is now a good time to invest? We're gonna have a slide later. The answer is typically yes. There's definitely been a couple months over the last 8 years that have been bubbles, and that in hindsight we're not the best times to invest. But generally, when you're investing in something super disruptive, it's going to go through booms and busts. But ultimately, if it is as disruptive as we think, your entry price is going to be a small fraction of the ultimate price. And we've seen that in other disruptive things, like Apple stock was trading at 50 cents in 2000. So you see these wild gyrations, but throughout the cycle, the disruption is so powerful that it really powers through your cost basis. And we've seen that in the IRR of our funds. We've created 8 different funds when you count the 3 venture funds we've done, and there are 3 versions of our early stage token fund. We've invested throughout all the 8 years of booms, busts, bubbles, nuclear winners, everything. And the average IRR across all those funds is 129%. And I think that's a testament to how fantastic our team is. That our team is 40 people strong. It's amazing, but it's also it's a function of this is such a disruptive space that a rising tsunami is floating a lot of boats. And with that, I want to hand it over to my co-CIO Joey Krug to talk about our thoughts on why blockchain is a compelling opportunity.
Awesome. Thanks, Dan. So at a very high level, I'd say the thesis of Pantera is that blockchain tech and cryptocurrencies are sort of the underpinnings or beginning of a new financial infrastructure, similar to how the internet was the underpinning of a new information infrastructure. And so what that means is this tech is going to transform finance. Basically, every aspect of finance we think will be transformed by blockchain tech and smart contracts. And we're starting to see a lot of that in kind of the initial nascent DeFi markets. But first, let's talk a little bit about the evolution of protocols in the space, starting with Bitcoin. So when Bitcoin came out, it enabled global transactions. You could send a payment from point A to point B globally, anywhere in the world, at very low fees, and it would happen within 10 minutes or so. And so Bitcoin solved a really hard technology problem. It solved this problem of how do you send money digitally without someone being able to spend the money twice. So that's called the double spend problem. basically preventing counterfeiting of funds. With Ethereum basically took the idea behind Bitcoin and said, what if we added programmability to it? And usually in the history of kind of technology, when someone asks, what if we add programmability to something, it usually gets a lot more interesting. And so with Ethereum, these smart contracts basically allow you to create any sort of financial contract or financial arrangement that you can think of. If you think about it in a very simplistic sense, all the financial system really is a complex series of if then else statements. Now those statements may be backed by hundreds of pages of legalese with multiple intermediaries and entities kind of sitting in the middle of every transaction. But at the core of it, it really is these kind of statements that basically control where money goes from and to under certain conditions. And Ethereum basically said, what if we just replaced all that with fairly simple software? Now, the problem with Ethereum so far has been that it doesn't scale. So if you think about the global financial system, it's processing a lot of transactions per second. One number people like to throw out is Visa can do about 2,000 transactions per second. Bitcoin does about 7. Ethereum does about 15 to 20 per second. And you need to be able to do thousands in the long run. And so there's a bunch of different approaches towards solving this, things called layer 2s that are built on top of Ethereum, and also other blockchains like Polkadot. Polkadot basically allows anybody to sort of launch their own blockchain that interacts with the Polkadot kind of main chain. These are called parachains. And because of that, you can sort of launch your own app on its own blockchain, and you basically have a lot higher scalability. So Polkadot is actually quite fast. It can do hundreds of transactions per second. So it's much more scalable. And so looking at decentralized finance, like I mentioned earlier, we think that there's really 5 key components of any financial system. And then there's obviously a lot of other complexity that kind of exists using those individual components. But the 5 key ones are you need a unit of account, so you need a currency to denominate trades in. Globally today, that's mainly the dollar. And in DeFi, that's no different. A lot of the trading happens in stable coins, things like USDC, USDT, basically digital versions of the dollar. Then you have exchanges that allow you to actually trade assets. We'll talk about those in a moment, but those are actually getting very popular. Then you have borrowing and lending. You basically have debt. Right now, most of the debt is collateralized lending, so it's not really uncollateralized loans for the most part. That'll eventually come, but right now it's collateral backed. And then you have margin and leverage. And these are kind of key components of any financial system. If you think about maybe you're a business and you need to hedge, dollar yen, currency risk, doing that at 100% collateral, no margin, no leverage, is very capital inefficient. So there's scenarios where it makes sense to have margin and leverage. They're not as bad as people tend to associate these instruments with the financial crisis. But there's actually many kind of benevolent, good use cases of these two things. And the great thing about DeFi is it's all open and public, so you can actually track how much margin is being used, how much leverage is in the system. It's a lot easier to get a kind of window into what risk looks like. And so looking at the DeFi ecosystem, at the very bottom, you have these layer 1 blockchains, things like Polkadot, Ethereum, Cosmos, Near. One layer up from that, you have oracles. Oracles are basically what gets you real world data into the blockchain. Say for some reason you had a financial contract that needed to know what the price of Apple was, or the price of gold. Oracles basically enable you to securely get that data from the real world into something like Ethereum. One layer up from that, you have kind of the core DeFi protocols that I've talked a bit about, lending protocols like Maker and Compound, decentralized exchanges like Uniswap and 0x, synthetic assets protocols and derivatives exchanges that let you basically bet on things from like a synthetic standpoint where you're not actually trading an underlying asset. Mirror lets you basically trade things like Apple and Tesla stock globally, but where the market is traded 24/7, so there's no market hours. That's one of the other big advantages of this tech is there aren't things like market hours. And then last, you have aggregators. This is actually where I think long run, most of the users will go to these apps. They're not going to go directly to Compound or Maker or Uniswap. 5 years from now, they're going to go to an aggregator, which sort of handles it all for them. And the aggregator just gives them like kind of a simple user interface see what they want to do, whether that's borrow and lend or do a trade. And so looking at crypto lending, this area of the market has gotten a lot of traction, primarily because it's very easy to use, and you can borrow something 24/7. There's no market hours. If you want to take out a loan, or if you want to borrow an asset and go short, you can do it at 3 a.m. if you want to, using something like Compound or Ovid. And so right now, there's about $43 billion locked in these lending protocols. A year ago, it was a much smaller number, something around $1 billion. And so this stuff is growing very, very quickly. And then you have decentralized exchanges. And so on the decentralized exchange side, these allow you to trade digital assets without a third-party intermediary. There's actually reasons why that's beneficial. With third-party intermediaries, they're often slow. You have to wait for them to process your withdrawals. It takes a long time. You have to trust them to not lose your funds. But when you trade with something like Uniswap, you have the custody of your funds. You go to it, you do the trade happens in 30 seconds, and then you have your other asset. You don't need to withdraw it from Uniswap. It just appears in your wallet. Other benefits are that since there's not really a middleman, the fees are much lower. And the slippage is also often much lower. Many times you can trade some pair on a decentralized exchange at a lower rate or a better rate than you can get on a centralized exchange, depending on the asset. And so one metric people use to track decentralized exchanges is kind of how much money is being used to market make on them or provide liquidity to them. And it's quite a lot. It's about $26 billion right now. There's roughly 40 decentralized exchanges or DEXs in the market. I'd say there's maybe 10 of them that actually see kind of any real usage numbers. And then you have stablecoins. One thing you hear a lot about in the news is everyone talks about these central bank-backed digital currencies. Is there going to be a digital version of the dollar that the Fed issues? And who knows? Maybe that will happen 10 years from now. I don't really know. But the interesting thing is you can get whatever benefits you can envision from the digital dollar today using something like USDC, which is backed by dollars in bank accounts, but you've effectively tokenized it and put it on a blockchain where you can then send dollars around. They're backed by real dollars in a bank account somewhere, but you can send them, globally 24/7, no banking holidays. So if you want to send somebody USDC, at 4 a.m. on Christmas morning, you can do it versus your bank is not even going to pick up the phone. So I think the stablecoin kind of market is something that's really exciting. A lot of trade in the crypto markets happens in stablecoins. 3 or 4 years ago, everything used to trade versus Bitcoin. Nowadays, most assets actually trade versus stablecoins like USDC or Tether. There's about $70 billion in total market cap in stablecoins right now. And I think that number is just going to continue to increase. So the digital dollar is already here. There's about $70 billion worth of them. I think there's like 2 trillion of US dollars in circulation in total. So it's actually like not a small number of those that are already digital versions of it. And then last, before handing it back to Dan, I think if you look at these charts on DeFi growth, there's 2 metrics here that are really interesting. One is the value locked in DeFi protocols. So you can sort of think of this like how much money has been ported or transported over to this new financial system versus how much is kind of left in the old one. And a year ago, it was something around $1 billion was in the new crypto financial system. Now it's something closer to $80 billion, and that's like an 80x growth in 1 year. And it's still growing really rapidly. At the beginning of this year, it was something like $20 billion. And so it's almost grown 4x in this year alone. And we think that's going to keep happening. And this market is fairly small. If you think of all the dollars that exist in the traditional financial system, that's the TAM here, the total addressable market for DeFi. And so it's really just day one. And I think that this number, it's going to 100x in the future, if not more. And then the next column, you have decentralized exchange trading volume. Again, back in April or May of 2020, it's around $1 billion a month. Now it's around $80 billion in trading volume a month. And that's another number that I think is going to keep continuing to increase, especially as decentralized exchanges get more and more capital efficient. On Uniswap version 2, often many days you could trade on them at better rates than centralized exchanges with a major pair like ETH versus USDC. With Uniswap v3, which is even more capital efficient, I think that's going to happen more and more often, where you can actually get a better rate by going to a DEX. And then all of a sudden, you're not using a Dutch decentralized exchange because you have some ideological decentralization reason to use it. You're using it because it's actually a better product. And I think that's going to cause DEX volumes to skyrocket even further. And so with that, I'm going to hand it back to Dan to talk about the macro case.
Thanks, Joey. So Joey's overview of the technology and the fundamental underpinnings are very strong, but there's some very timely things that are driving crypto right now. Two of them are the unprecedented monetary stimulus in response to the virus, and then the institutional adoption of crypto. These are a handful of graphics to visualize how much the money supply in the world is changing. And it's no coincidence that the price graph of Ethereum, Polkadot, Uniswap, Bitcoin looks just like the price graph of the quantity of paper money. We'll return to that in a couple of slides. The next slide is one of my favorites. In June, the United States started printing more money each month than it did in the first 200 years of its existence. That is obviously creating a lot of pressure on things whose price or whose quantity cannot be eased. So the price of everything is going up. The next slide, we've taken the price of the US dollar as a proxy for other paper money out there and repriced it in terms of things that you cannot ease the quantity of, like gold or grams of sugar or barrels of oil, even lumber. The price of paper money is plummeting, and that's really what's actually happening. All the rest of these things are relatively stable. It's really the price of paper money that's moving. It's all relative. The other big thing that's happened this year is legendary investors have come into the space. Investors like Stan Druckenmiller and Paul Jones. Both of them have said that it reminds them of gold, and that's a great analog. And one of the surprises on that previous graph is that gold is the least good performer of all of those things, which is potentially counterintuitive to people who aren't into crypto. They would have thought that if paper money was being debased, that gold would do well. But I think gold's losing a ton of market share to Bitcoin. So investors like this are investing in Bitcoin instead of their old school version of gold. And then you have super high profile people like Elon Musk, very publicly buying Bitcoin for his company, Tesla Motors, and going on Saturday Night Live this weekend to talk about cryptocurrencies, which is a pretty wild happenstance when culture and economics are coming together. The other big change is corporations now are putting Bitcoin on their treasury balance sheet. A company called MicroStrategy was a $1.5 billion software company, and now it's a $6 billion Bitcoin proxy. A lot of people are buying that stock to get exposure to Bitcoin because there aren't very many public companies that have that. Square's been invested in space for 3 years. PayPal, MassMutual, all these companies are going live, and that's what's driving the supply and demand imbalance. The last thing is regulatory clarity. In the United States as a proxy for the rest of the industry or the world, most of the regulatory bodies have been very clear about crypto. The IRS ruled it was property 8 years ago, and the CFTC supported futures. Really, the last bit is for the SEC to decide how to handle crypto assets. Okay, so where does that leave us in terms of the market? The reason I think this is the most compelling trade I've ever seen in my career is just the asymmetry. It's a new disruptive technology that's disrupting literally the biggest markets on earth. It's disrupting global payments, gold, money, the biggest things that are involved in everyone's lives. Basically anybody with a smartphone can participate in blockchain, and that's 3.5 billion people. It's actually had a very consistent growth rate. People say, oh, Bitcoin's too volatile, but It's had a couple of bubbles and it's had a couple of savage bear markets, but when you graph it exponentially, it looks pretty consistent. It's been going up at a 233% compound annual growth rate for 10 years. And yes, sometimes it gets a little ahead of itself. Sometimes it gets a little behind. Right now, it's actually spot on. It's exactly right in line with its growth rate. So when people ask, is today a good day to invest in Bitcoin? It's a pretty good day. It's been cheaper in the past and it probably is going to be more expensive in the future. But right now we're right on the 10-year trend growth for it. The other reason to have it in one's portfolio is it's one of the only, it is literally the only $2 trillion thing that has no correlation to anything else. The reason it has such a low correlation is not that many people own it yet. In 10 years, when everybody has cryptocurrency in their portfolio, it will be highly correlated with other things. But for now, it has a very low correlation. And for those of us that studied modern portfolio theory back in college, what you're looking for is an asset with a high expected return with a low correlation to other things. And I don't think we're ever going to see another thing that has a 233% compound annual growth rate with zero correlation to anything else. So it definitely deserves to have some exposure in all portfolios. So where could we possibly be going? On the next slide, we have a really amazing confluence of two data series. It's the number of people using Bitcoin and the price of Bitcoin. Both of those series have gone up 5 orders of magnitude, which is just an astounding amount of change and kept exactly the same ratio. It is exactly $200 per million people using Bitcoin. There's only one time that it didn't work in 16 and 17. The price was a little slow to hit the target. This would imply that the price of Bitcoin might hit 200,000 next year. I think it's imminently possible. That also raises the question of where could we ultimately go with the price of Bitcoin? This is just a little thought experiment. The terminal price of Bitcoin, could be something like $700,000 because there are 3.5 billion people that possess a smartphone, which is the required thing for entry into the blockchain ecosystem. How does one value cryptocurrency? It's a kind of a tricky question that people to go after. And I know it's unsatisfying to some, but utility tokens like Bitcoin, which don't have cash flows, and some of the DeFi tokens do have cash flows, really are just supply and demand. It's Econ 101. And if you have surging demand, like bringing in new firms like PayPal or Morgan Stanley or JP Morgan into the ecosystem, that shifts the demand curve up. And then if you have the supply being cut, like it was last year when the number of Bitcoin issued to the market was cut in half, that shifts the demand curve, the supply curve to the left. The curves are both very steep. It takes much higher prices to induce many people to sell. So the price has to go up to equilibrate supply and demand. One of the main knocks on Bitcoin is it's too volatile. You hear that all the time. And admittedly, it's had 4 bear markets that have averaged 83%, which is pretty amazing from a normal asset market standpoint. But on this next slide, it shows that there's only been 1 down year. That's just wild. So even with 4 83% bear markets over the years, even after going down 83%, you end up at a higher price than you started. And so for those people trying to get their investment committees to pass allowing Bitcoin to be in a portfolio, this is probably the easiest way to describe it. That anyone who's held Bitcoin for 3¼ years has made money, and we are always advocating taking a multi-decade approach to cryptocurrency, but even over 2 years, it's typically made money. And with that, I want to hand it to my partner, Paul Brattataka, to talk about the opportunities in the space.
Great, thank you very much, Dan. So we're going to talk about some of the investing opportunities in this space. If you go to the next slide, just want to let you guys know that we are thinking about including the full spectrum of assets here. We believe that there are value all across both tokens and equity, both early stage and late stage. So for us, we want to make sure that everything is sort of covered. If you look at venture equity, that includes both early stage equity and potentially late stage equity. And then on early stage tokens, it's the same thing as early stage venture capital, except there's a token involved, and the token is the business model and the way that the value is going to accrue. And then on the liquid token side of things, it's really being active in picking cryptocurrencies that are already on the secondary markets, one that we think are have tremendous sort of upside based on value, and ones that will be sort of cornerstone cryptocurrencies within the ecosystem. Obviously, venture equity and early stage tokens, there is access to those deals that are involved. Also with liquid tokens, I think we've really demonstrated that we can outperform the market and outperform just holding Bitcoin and Ethereum. In addition to that, we do actually create over-the-counter deals and transactions where we get 30 to 7% discount on these tokens compared to spot. So there is some sort of access advantage that we have on the liquid token side of things too. And talking about some of the properties of each of these assets, I mean, venture equity is equity, early stage tokens and liquid tokens are both involving tokens. In terms of return potential, we believe that early stage tokens probably have a slightly higher upside return potential at the end of the day. You get in there fairly early and you get, liquidity and upside in a shorter time frame, which is fairly attractive. But with that also comes high risk compared to venture equity. Early stage tokens are early stage companies, but in addition to that, there are some risk around just kind of getting these things off the ground from both a sort of technology and legal perspective. And then, of course, liquid tokens are already out on the market. They're fairly later stage, and then venture equity is just early stage venture capital. And then in terms of liquidity, I'd say liquid tokens are the most liquid. You could trade $80 billion of Bitcoin a day, and then early stage tokens, the time to market is much lower, so they're a bit more liquid, and then the lowest liquidity is venture equity. As mentioned, investor accessibility, venture equity and early stage tokens have the sort of lowest accessibility, and then liquid tokens are a bit more accessible. And holding periods, ventures typically a bit longer, while early stage tokens, usually I'd say it's around a few months to 12 to 18 months, and then liquid tokens, we can trade them in a fairly frequent manner. So why all three? I mean, at the end of the day, we believe that value will accrue to all three. And, it makes sense to have all three just so that it's just diversification, knowing that sometimes the market changes, and therefore, during a bear market, it's actually the best time to be investing into assets. And so, I think a lot of investors kind of come in toward the peak and then sell low. For us to sort of have this structured as a VC fund, we could sort of ride multiple cycles and be able to sort of help manage and create opportunities and upside, especially during the bear market. So I think that's also really, really important. I also think that, again, while all three assets have great return potential, it's great to have a mix of each, because at the end of the day, you want to make sure that you can capture upside wherever this space sort of heads. And I think the last thing that I'll talk about is the flexibility. So knowing that especially on the early stage side, tokens and equity, companies are early stage companies, they can kind of go back and forth in terms of how they sort of figure out their business model. And so it just makes things easier just to have sort of an early stage sort of bucket, just to be able to have flexibility, move those assets within those buckets, instead of having to kind of figure out whether a company is strictly going to be on the token side or strictly going to be on the equity side.
Thanks, Paul. So that gave us the impetus to provide an all-in-one blockchain fund. So on the next slide, we have a visual of how we ended up with 4 different funds. We launched each one of these types of funds over the years. And any asset can only go in one of our funds, with the exception of Bitcoin, which can go in 2. So we've ended up with 4 funds, which has been great for some investors that wanted very specific, focused liquidity or asset types. But for those that wanted to allocate, say 100 basis points of their AUM to blockchain as a concept, there's a few of our LPs that have essentially invested in all 4 of our funds and created their own DIY blockchain fund, but we are now launching a product that does that. So it's essentially doing exactly the same thing we've been doing every day for 8 years, but with a new wrapper that makes it better for many investors out there. The next slide has some of the details. We're targeting 600 million. That's about 12% more than our current AUM. So it should be doable without really changing what we're actually doing. It'll be about 40% invested in venture over time, and then probably 30 or so % in early stage tokens, and then the balance in liquid tokens. And I just want to make the case for liquid tokens. Some venture firms, put some Bitcoin or maybe even Bitcoin and Ethereum in their portfolio, and that's kind of it. Our view is, that isn't it. In the earliest days, 6-7 years ago, Bitcoin was everything, and you didn't need anything else in your portfolio. And then having Bitcoin and Ethereum was kind of enough to cover the markets. It really isn't anymore. There are so many very important protocols that are not Bitcoin or Ethereum. And a good example would be, so far this year, Bitcoin is up 95% year to date, which is obviously awesome in any normal type of market. But our liquid token fund is up 449%. So there's an enormous amount of alpha to be generated by being long the correct tokens in the space, not just kind of a passive index like Bitcoin and Ethereum. And with that, I want to hand it back to Paul to talk a bit about the blockchain fund strategy.
Thanks, Dan. So I'll talk about the venture capital equity strategy and the venture capital early stage token strategy. And then later on, we'll get into some use cases for each of those strategies. So on the venture capital equity strategy, we've done 3 VC funds already, and we'll get into the performance of those funds. They've done very, very well, but we've done very well in terms of leading seed and Series A rounds for companies. So we want to continue to do that. In addition to that, though, we are seeing opportunities in Series B and Series C rounds. Some of them are within our portfolio, some of them are not within our portfolio, and those are actually just as competitive, if not more competitive, to get into, just because you start going in and competing against some of those growth funds. But with Pantera's expertise and value add and sort of relationships with these companies, we do have an opportunity to participate. And in addition to that, sometimes these companies are just generating so much cash flow in the early going because they are an exchange or a brokerage that they kind of skip the Series A round and go from a C to Series B. So we just want a bit more flexibility there. So check sizes will be sort of between the $1 to $15 million range. We've led about half of our deals, so we'll probably do the same. And for us, we're going to be focusing on just continued investment into infrastructure, whether that's centralized finance or decentralized finance. We're starting to see payment use cases, especially with stablecoins. And, we think that cross-border payments continues to be a very, very lucrative opportunity for cryptocurrencies. And I guess the last sector that we're starting to see a lot more traction in is on consumers. You guys may have heard of NFTs. Floyd Mayweather is about to launch an NFT, and we think that that will be one of the use cases that helps bring cryptocurrencies to the mainstream. Next, we'll talk about early stage tokens. So think of early stage tokens as early stage venture, but with a token business model. And what that means, for instance, something like Ethereum, you need Ether to sort of facilitate transactions, or maybe it's something like Augur where you get paid to actually report accurate data for the decentralized prediction market to sort of function, things like that. With these early stage token rounds, they are a bit smaller in that, to get a decentralized project off the ground and listed, you could raise maybe up to a few $1 million and still make that happen. So we are going to be focusing on the first and second rounds, any round that is pre-token launch. And so that means our check sizes will be between $500,000 all the way up to $5 million, getting anywhere between a few percentage points up to maybe even 10% of a token network. Really the value here is, we can evaluate and help on the technology side. We can really help in terms of bringing our brand and our thoughts around community building, which is most important for an early stage token project, and also thoughts around team building, help with regulations, and help with just product and strategy. We're really looking for projects that are residing within our thesis and that we could really just help get to launch and then even just help post launch. So this strategy is investing into just token projects and into instruments for tokens before they actually hit the public market. And then I'm going to switch it over to Joey for the next section.
Thanks. So the third portion of the fund is liquid tokens. And so I think the right way to think about this is, the liquid tokens in this space, we're primarily going to be focusing on decentralized finance assets because that's where we think the most value is going to be created. Right now, DeFi assets are 4 to 5% of the total kind of overall cryptocurrency market cap. But we think that's where 75 to 80% of the value is going to be created. And so we think that spread between those two numbers is going to narrow. It's going to be very positive for DeFi assets. And since these things are also early stage, they're really like venture capital investments. They just happen to have a real-time price feed. And so what we'll be looking to do is buying the ones that we think are sort of the most undervalued on a relative basis, and also managing that, sometimes trading them around. For instance, if we think that, Compound versus Aave is undervalued at one point, that later may change, and then we would reverse the trade and own more, Aave instead of Compound in the fund, or the reverse. So we'll do that sort of thing. And then also trading around on a bit more of a macro standpoint, things like Bitcoin versus ETH and altcoins versus Bitcoin. That's something we've done a lot in our existing liquid token fund. We've also taken a fairly active, especially this cycle, active role on risk management in that fund. So when we think the markets are getting overheated, we'll de-risk 25 to 35% of the portfolio and then redeploy it once we think things have cooled off a bit. And so we'll be doing those sorts of strategies in the blockchain fund on the liquid portion as well. I think I'm going to pass it back to Paul to talk about our edge.
So now that we're starting a fund that is all in one and has assets that we're going into on both the private and public side of things, I really think that's kind of where our edge shines. Having both the experience managing sort of public equities and also investing into private assets. I think that's sort of unusual across any sort of set of funds and fund managers within this space. Dan's background at Tiger Management, and Joey and myself sort of doing a bunch of private investments in the past. And so I think this really just kind of gives us the ability to sort of manage these assets from beginning all the way throughout their life cycle. So taking a look at our equity strategy, as you can sort of see, we've had 3 venture funds so far. The first venture fund was really focused on how do we get to securely access cryptocurrencies? How do we store them? What are some early ways to speculate on cryptocurrencies? And that included some companies like Bitstamp and Zappo and Circle and Ripple. Venture Fund 2 was targeted more around cross-border payments and regional exchanges. And then I'd say Venture Fund 3 was really seeing the institutionalization and the tooling needed for both developers and institutions to access this space and the birth of decentralized finance. So as you can see, the results have been great so far. Venture Fund 1, I'd say, kind of the bare bones infrastructure and hitting some of the first movers in the space. And you can see that the TVPI has been fairly attractive at 7x. Venture Fund 2 was sort of in that middle where still trying to figure out product market fit and still fairly early, yet even the sort of worst performing fund of the three is still at a TVPI of about 5x. And we're really starting to see some of those companies from Venture Fund 2 starting to blossom right now. And, we think that that number will continue to go up. And then Venture Fund 3 just really caught a great timing in the market where, it was at least for myself, the first real significant building and installation phase and a bear market after the 2017 run up. And I think we're going to see a tremendous return from this fund, and we're already seeing it. It's been about 2.5 years in. Our token related venture equity investments have really driven the fund performance numbers so far, but we're starting to see a lot of our infrastructure investments starting to hit growth stage rounds, sort of in the hundreds of millions to billion-dollar valuations. What's really interesting is that, we've been able to just generate quite a bit of M&A activity from our portfolio companies so far, where, the gross TVPI of our exits has been about 8x, and the loss ratio for us has been fairly lower than sort of traditional VC funds. And I think it's because we're early in the market. It's a cutting edge space. Talent is the most scarce asset right now. And, for us, we're able to sell, I think, our portfolio companies for, at least our cost basis, just because of the technology and because of the talent that's out there, as we're betting on very, very good teams. So it really does give us an umbrella and sort of a threshold to sort of, provide some comfort for investors on the risk sort of spectrum. And then next, I'm going to talk about some of the portfolio examples by sector. So, this really just kind of fits in all the different things that we think are sort of needed for the space, starting with Alchemy. Alchemy provides a developer platform to more easily develop applications on any sort of blockchain, starting on Ethereum. Right now, you have to, build some of that infrastructure yourself and maintain it. And that, can cost an engineer or three. And so Alchemy just makes that just like hooking to an API, and you can really then get more and more APIs to make it more easily, develop, for you to develop on top of these blockchains and monitor your applications, things like that. We think cross-border payments is also a strong use case for cryptocurrencies. CoinMe allows any sort of cash to crypto access into a mobile wallet and make it easier for you to sort of send that value across borders. So they're partnered with Coinstar, which gives them access to 20,000 global locations to get a mobile wallet that has cryptocurrency, and then you can send that across borders to any sort of other Coinstar or any other sort of potential partnership that they have on the cross-border side of things. Bitso is an exchange and brokerage that we invested into in the sort of seed and Series A round. They are basically the Coinbase for Latin America, and they facilitate about 7% of the remittances between the US and Mexico. So both from a speculative asset, both from sort of a cross-border payments aspect, and lastly, from a yield aspect, they're really bridging Latin America into cryptocurrencies, which is amazing. In terms of enterprise and scalability, Off-Chain Labs, Joey mentioned that a lot of the scalability that's going to happen on layer one blockchains like Ethereum are going to actually happen on a different layer off-chain. And off-chain is focused on scaling Ethereum right now, and it has a best-in-class team with PhDs from Princeton, and they are pretty much the first significant one built on optimistic rollups to hit the market. So we're really excited about that one. That is our bet on the institutionalization of cryptocurrencies, and being sort of funded by ICE, the parent company of the New York Stock Exchange, Bakkt has really rolled out a futures product that is going to help bring institutions to get exposure to Bitcoin. In addition to that, they have a consumer wallet that allows anybody to get access to not only cryptocurrencies, but any sort of digital asset, which includes airline miles, loyalty points, Target gift cards, etc. And then the last company that I'll talk about is called Staked. I'm on the board of Staked, and if you guys have heard of staking or proof of stake protocols, it's basically, staking or voting, I guess, almost with your tokens to help sort of validate and secure transactions on a network. Those that actually perform the sort of validation of the transactions are ones that are being delegated tokens, and Staked is sort of a company that provides, I guess, proxy voting for staking. And they provide that infrastructure for a bunch of different blockchains and a bunch of different DeFi applications within our space. And we think that that eventually turns into some sort of Stripe or sort of yield management product that services both institutions and developers. So, one question that we've gotten is really, how does Pantera maintain access to great deals and deal flow? And the answer to that is really just, number one, servicing our portfolio companies. The more that we can provide value to our portfolio companies, the more that, they are serving as great references and can really just speak to the value add that we bring them. And I think that's the best way to continue to maintain deal flow, because entrepreneurs go to other entrepreneurs to ask about who within their cap table has provided value and are great investors. And whether we are small or large investors, we've always gotten feedback that we've been, the best investors to work with. And then the other sorts of channels that we provide a lot of value to is actually being sort of an outsourced CIO to a lot of venture capital firms that are looking at cryptocurrency companies within the space. It's really easy to get up to speed when you can reach out to a partner that knows what's going on, knows the competitive landscape, and that sort of thing. And then, of course, calls like this, where we're spending a lot of our time educating the public and sharing our thoughts about the space, really have just created a great brand for the industry as sort of thought leaders. And I think that brand really helps bring us into the cap table of a lot of companies where they're hoping to sort of create more legitimacy and a lot more trust. And then next, we'll quickly talk about the early stage token fund, and manage about $2.3 billion of AUM right now. Lifetime to date performance has been about 1,800% returns. And if you look at the types of companies that we are investing into, we're investing into everything from DeFi, which is related to payments and decentralized trading, decentralized file storage, which is a bet on Filecoin, and then decentralized marketplaces. Origin is an example of one of them. They're focused on NFTs, but another one is called Braintrust, which is focused on talent and hiring. And I'll talk quickly about two use cases. One is called Polkadot. They provide an alternative to Ethereum in terms of a blockchain that can, scale in terms of transaction throughput, and also having folks be able to launch their own blockchains and have sort of interoperability between their own blockchains and the main chain in terms of scaling. So, the main draw of Polkadot is it was started by the CTO of Ethereum, Gavin Wood. And, we've been early investors in Polkadot since the first round. And it's generated a 132x return for our early stage token fund so far. The main value add that we've been providing to Polkadot has been, funding companies within the ecosystem, voting, and providing sort of liquidity for different projects to actually launch their own parachains. And so we think that the community aspect of what we're doing on Polkadot is very, very strong and is very applicable to other companies that are hoping to sort of build underlying platforms for developers to build on top of. We've done some events with Polkadot and we continue to be huge supporters. In terms of Dodo, it is think of them as an on-chain liquidity provider. So similar to Uniswap, but instead of an AMM model, they use a proactive market maker, which uses oracles to generate better trading and better slippage. And they really focused on the, coming from the Chinese market and having strong DeFi experience, starting another decentralized exchange. They've really sort of marketed themselves well in the Asian community. And their product started off as just a liquidity provider, and they've expanded over to sort of decentralized aggregation. They've now provided ways for token projects to launch on top of their platform, and they're getting into things like NFTs, et cetera. So I kind of consider them sort of a DeFi full stack hub for the Asian demographic, but even expanding beyond that. And we invested fairly early on. We led their, I guess, Series A, and so far the investment has been a 85x return, and we've been very helpful for them to really just, partnerships and also fundraising. And I'm going to send it over to Joey for our liquid token stuff.
So looking at the liquid token market, Pantera has been invested in that since 2013, when Pantera's Bitcoin fund launched, when Bitcoin was about $65. In 2017, sort of near the peak of the market, we launched the liquid token fund, which is a multi-strat fund that gives exposure to sort of the full spectrum of digital assets, basically things that are not just Bitcoin. And that fund's up about 604% life to date. Currently manages around $500 million. And if we go to the next slide, one of the most common questions we get is, why not just buy Bitcoin? And I think there's two reasons. One is that there's a lot of assets in the space that are doing a lot of interesting things beyond just what Bitcoin's doing. So Bitcoin gives you exposure to digital gold, but if you want exposure to decentralized finance, you basically need to buy assets like Ethereum and protocols built on top of it. And so Bitcoin won't get you that exposure. The other answer is from a performance standpoint, active management can add alpha in two ways. One is selecting assets that are kind of outperforming the market. We've done trades like buying Aave relative to Compound. We bought YFI early. We sold it kind of close to its local peak versus ETH, and then we bought ETH with the proceeds. So there's a lot of active things you can do beyond just buying a set of assets and holding them that actually improve performance. And then the other is kind of risk off techniques, basically deciding when to put risk on and reduce risk. And so we've been doing that this year in our liquid token fund. You can see in this performance chart below, since February to now, the liquid token fund's up about 77%. The early stage token fund is up about 87%. And Bitcoin itself is up about 10%. And with that, I'll pass it back to Dan.
Thanks, Joey and Paul. So there've been a ton of great questions in the Q&A box. We've answered a lot of them in the written format. I'll answer the remaining ones live here. A lot of them have to do with terms, so this is actually a great slide to close on. The structure of the fund is it'll have so the closings. We are going to have a closing on June 30th. I know this is a tight time frame for institutions, but we have an amazing amount of live deals in the pipeline, and we want to be able to have those in this new fund. So we will have a closing on June 30th. We'll certainly have subsequent closings, maybe 2 more at the end of subsequent quarters or something like that. To the extent people want to invest in this first closing, do get in touch with our IR department at ir@panterracapital.com. The way it'll work is it is a 10-year venture style fund, but we are having a preset capital call schedule. So it's kind of a mix of hedge and venture. On closing, it'll be 25% of the commitment will be called in capital. And then for the next 2.5 years, it'll be equal quarterly installments. So the capital call schedule will be very fixed and known. What we'll do is we'll put some of that capital to work immediately in venture deals and illiquid tokens, but we might also put some in liquid tokens. And then as we have capital calls over the next 2.5 years, it should sync up with the investments that we find in the illiquid space in venture. We have a 5-year investment period on this fund. So within the first 5 years, to the extent we sell a token and think there's another token that's more interesting, we'll just reinvest it in that new token. But at the end of the 5th year, any sale we make in tokens will go back to LPs. On venture investments, we can recycle up to 20% of the venture exits into new deals, again, only in that first 5 years. And then after that, all the capital will be returned. There've been a lot of questions from our current LPs whether they can join this June 30th closing. It's subject to capacity, so we don't know. So if you're interested in investing and you're currently an LP, obviously we'll want to waive your redemption notice periods if we can, if we have capacity, and it's going to take us probably until sometime in June itself to know whether we're going to have enough capacity to do that. So if you're a current LP and you want to invest in June with proceeds from redeeming from one of our other funds, let us know and we'll put you in a queue. To the extent we have capacity, we'll try and help all of those. Question on, is there going to be a venture fund 4? No, this is the next venture vehicle for Pantera. So venture fund 3 is almost done being invested. It will be done this summer. As soon as venture fund 3 is done investing in new deals, all new venture deals will go into the blockchain fund. There is a question on whether we're going to discontinue the early stage token fund and the liquid token fund. No, those are evergreen hedge funds. They're going to remain open. They will then split early stage token deals with this new blockchain fund. So when we do a new early stage deal, it'll be split between the two funds based on their AUM. The liquid token fund, obviously, as well as an evergreen fund, will keep doing what we're doing there. All those positions are very liquid, so it won't have any impact on the blockchain fund itself. And for those of you who are experts on our products, you know that our liquid token fund does include 10 to 25% in a quant strategy. That strategy will not be replicated in the blockchain fund. The blockchain fund will only be long things and be long them for greater periods of time than the high frequency trading that we do in quant. And there was a question about whether this new fund will short things. No, it won't. The only fund we have that does short things is the liquid token fund. And even there, we don't short things very often. Very important, we always want to offer co-investments. We know our LPs want a great IRR, but they also want to be able to co-invest in deals to learn how the space is working. Each of our deals, venture funds, has had a co-investment class. This one does as well. Unfortunately, the criterion to get into that has scaled with the fund itself. So it will be for investors that have invested 15 million or more. We'll have rights to co-invest at least 10% of every deal. And then as our current LPs know, we are very aggressive at trying to help LPs get invested into deals, excuse me, even if they don't have co-investment rights. So once we've filled the co-investment class that has actual obligation or right to get into every deal, to the extent we have excess capacity, which since as Paul said, we lead about half of our deals, we typically do, we offer that to all LPs. So that will still be available. The minimum for the fund is 1 million. And again, that has changed. We've made an enormous attempt over the last 8 years to remain accessible as we evangelize this new asset class. And almost all of our funds have the statutory minimum of $100,000, which we typically like to retain. But in this fund, it's a bit more institutional. And so it's a 1 million minimum. So a couple other questions. People had asked, how much the general partners are investing in this new fund. We'll invest at least 10 million in this fund. The GP is either the largest or second largest investor in most of our funds. We typically own 10 to 20% of funds. So we will probably invest much more than 10 million over the years. The other question was, are blockchain assets going to be correlated to other assets? And I think the answer is definitely, but it's going to take 5 or 10 years. That right now, since not enough people own it, it's got a very low correlation. So it'll remain relatively low. And then in time, when 5 or 10 years from now, when everybody has it, it'll go up. There was another question on the SEC and why it hasn't approved an ETF. We had a great dialogue with SEC Commissioner Hester Pierce at our summit. And on our website, we have all the summit content for those of you who weren't able to participate. And she's been a very vocal proponent of approving an ETF and says that the SEC is holding Bitcoin to a much higher standard than it does other asset classes. I think that's a very reasonable statement. They have ETFs and things like platinum and palladium that are essentially controlled by one Russian oligarch, so are highly manipulated. Here, Bitcoin trades $70 billion a day on hundreds of exchanges and in dozens of countries, so it's very difficult to manipulate it. The other perspective we put in our investor letter a few months ago is GameStop. Even before the mania, GameStop was only trading $70 million a day, so 1,000 times less, trading only on one exchange in one country. And then obviously these so-called free trading apps like Robinhood were able to massively influence the price of those stocks. So I would think the new SEC chairman will probably take a more open-minded eye to this. There's one other question on, Bitcoin's open source software. You can just copy it. You can make infinite number of copies. So why does it even matter that there's a finite number of Bitcoins when there's an infinite number of versions of blockchain? This is a question you get often. And I actually got it on a real kind of snarky interview with Andrew Ross Sorkin, where he said he's walking down the street and he saw, somebody marketing their own coin, and he and his wife were going to launch theirs. And I said, no, I got a better idea: photo sharing. If you can get 2.5 billion people to share photos on your website, it's going to be worth a lot of money. And that's basically the answer here: is 100 million people already use Bitcoin. So it's pretty tough to come up with a coin that more people want to use. And with that, I'll hand it back to Joey and Paul to answer a couple more of the live questions.
There's one question about mitigating drawdown impact, and also, will this time be different because of real use cases, or do we expect similar drawdowns to past cycles? I think you can still have a big drawdown even if there's real use cases. And the reason is that a lot of the use cases are indexed to crypto prices. So if ETH goes up 2x, DEX volumes are probably going to go up 2x because ETH went up 2x. Granted, decentralized exchange volumes are growing faster than just linear with the price of ETH. They're growing kind of super linear or exponentially, but still you'll have that same feedback loop in reverse in the bear market. And so I think, it probably doesn't draw down 85% again, but it wouldn't surprise me at all if the space drew down 70% or something in this bear cycle. And so that makes risk management and mitigating drawdowns important. We've been doing that a good amount in the liquid token fund throughout this cycle. We look at a few different things. We look at on-chain data, basically to see kind of how overheated or overbought the market is. Look at things like funding rates for perpetuals and futures contracts to basically see, how much are people paying to go long. If they're paying a huge amount of money, that can mean that you're reaching a local maximum. And then we also looked at charts to see whether there's a technical breakdown in the current trend. Is there a trend reversal? When those things tell us the same thing, we like to de-risk the portfolio. And so I think we'll do that sort of trading around in this fund as well to basically dampen the downside volatility. Obviously, we think things are going to be way up 5 years from now, but the reason why it can go up so much is that it's going to be a bumpy ride along the way. That's what makes this asset class interesting.
Joey, I'll take a couple. There's a question on LP priority for the new fund. Definitely, to the extent we have space beyond those that have already submitted redemptions, we will then try and give current LPs priority to waive their normal redemption periods and transfer funds. We'll also try and do it synchronized so that if someone's coming out at, say, the end of June or the end of September, the money will immediately go into the new fund, whereas typically it takes 10 or 15 days for money to come out of a fund. So we'll certainly try and do that. And there's a question on the expectations for the fund's investment and payout periods versus a traditional VC. In this fund, we expect to have the venture and early stage investments done within 2.5 to 3 years. That's been our average. We've done 3 funds over 8 years. So it is right in that window. Then we would expect to see capital coming back pretty quickly from equity investments being exited. We've seen that again in our first 3 funds. Venture Fund 3 is only 3 years old, less than 3 years old, and we'll be making distributions this year. So everything in blockchain goes at hyper speed. And then the investment period itself will be 5 years. So for the first 5 years, we'll invest in liquid tokens, early stage tokens, and venture. As soon as we've recycled 20% of venture exits, we won't recycle any more venture exits. And then after 5 years, we won't recycle any token investments. So you could imagine the fund starting to return some capital after, say, 3 or 4 years. And then after the 5th year, probably start returning capital at a pretty quick rate. And I'll let Joey or Paul take a couple questions.
There's some questions about ETH. What are the risks and the upside of it? I think the upside of it is that it becomes this sort of global financial settlement rail that we've been talking about with DeFi. I think risks are just does another smart contract platform get adoption? But I think the way the world's turning right now is that you'll have other smart contract platforms that interact with ETH, but ETH is going to be kind of the core hub. There might be certain apps that you launch on something like Polkadot or maybe Solana, and then those get bridged to send data to and from Ethereum. But they're not, they don't like they don't overpower Ethereum. They're just these like other things that exist. Is sort of how I see it.
Oh, and there's a question on, whether this is going to be difficult to add another fund into our mix. It really isn't, because it's exactly the same thing we've been doing for 8 years. It's just a different wrapper. To some extent, it's like offering a fund of funds which invests in the 4 products we already offer. So there's essentially nothing new in what we're doing here. And then we have been growing our team, over the last 8 years. It's now 40 people. We have a really deep investment team. Franklin B runs a group that is just there to support our portfolio companies. We have an in-house recruiter. So we've really tried to stay way ahead in the arms race to compete with other firms in the space. And at 40 people, I think we're probably, much bigger than most.
Yeah, I'll answer the question. I know there was a question on Dodo, and it looks like we did cover that question. But yeah, we're really excited about. Oh, actually, yeah. What perspective we transfer something like Dodo right now? I mean, if you're looking at the different sectors that Dodo is going after, both from a token launch perspective, decentralized exchange perspective, decentralized exchange aggregator perspective, and decentralized derivatives exchange perspective, I think the market size of what they're trying to do and the price potential is still tremendous. So we think that team is really, really good, and we're excited about continuing to help support them. And in terms of a dedicated team in Asia, so with DeFi, Asia has been a bit slower in terms of adoption, but they are starting to ramp up a little bit. NFTs, they're really starting to ramp up on NFTs. I think with the culture over there around KOLs, or key opinion leaders and things like that, and the fact that they have a lot of brands and influencers that do make money over there in Asia, that has gotten much faster penetration. And for us, we have really good partners in Asia, and we built up a very strong brand over there in Asia, where at this point in time, we don't need folks on the ground to help see deals or get into deals. We do have partners that give us deal flow and provide references and analysis for us. We spent a lot of time over there in Asia speaking at conferences, so I think we actually have the top global brand in blockchain and cryptocurrency over there. But eventually, as we do more deals over there, we may start hiring, but it's not in the sort of near-term roadmap.
There's one question whether there are any seed investments, if any. There aren't. We're currently investing for Venture Fund 3 and the Early Stage Token Fund. When we're done with the Early Stage Token Fund, with the Venture Fund 3 in the next couple of months, all new deals will go into the blockchain fund, but there's no kind of seed investments or any investments that are kind of in the side pocket or waiting. With that, I think we have answered actually all the questions that I'm aware of. There's one that says, what percentage of the fund will be allocated to Bitcoin? It's totally dynamic. And right now, actually, our discretionary funds have essentially 0 Bitcoin. We came to the belief when Bitcoin at 70% dominance 3 or 4 months ago that although Bitcoin itself would do well, we thought Ethereum would do much better, and that Polkadot would do even better than that, and DeFi even better than either of those blockchains themselves. So if the blockchain fund were existing today, it would probably have a very low weighting in Bitcoin. And then there is a question on liquidity terms, which we've answered. It's a 10-year style venture fund where all exits after 5 years will be returned to LPs. And then another question on the monetization of early stage token fund. It's changed dramatically over the years. In the earliest years, 2017, tokens were typically liquid very quickly. And then after the SEC came into the markets in 2018, things really slowed down a great deal, and it would typically take years to become liquid. It feels like the pendulum is swinging back now, where we have invested in some deals recently where liquidity happens relatively quickly. So our early stage token fund requires new LPs to give 1 year notice, and that seems to be appropriate. On average, it seems like it's taking 1 year. There's a question that someone asked, you get a lot, is what percentage of a fund should be in blockchain? And the only answer I know that's wrong is 0. Other than that, it's really based on what type of fund it is. I think in the long run, blockchain will probably be something like 6 or 7% in the global portfolio of asset managers. If it's a conservative institution, 1 to 2 or 3% is probably the right place to start. If you are a individual and you have plenty of means, and you wouldn't be bummed if you lost 80% of whatever you invest in blockchain, then you could go 10% or higher. But a good starting point is a few percent, for the typical institution. And with that, the question on mining is one where we've never invested in mining. We've invested in 125 things over 8 years, pretty much everything other than mining. And the reason we don't want to invest in it is it's incredibly capital intensive, and it takes knowledge of chip design, fabrication, and deployment that we just don't have an edge in, and I would imagine most venture firms don't. So we've always avoided mining, but that's literally the only thing we've avoided. And then someone else asked about how long do we expect this bull market to keep going? It's obviously the $64,000 question. It feels like it's going to keep going for quite a while. The new entrants to the space, like Morgan Stanley, firms like that, I think that has to give you, a lot of runway. Like it takes a while. It's taken 7 years for Morgan Stanley to approve cryptocurrency, but now that they have, it's probably going to take 6 to 12 months to have a lot of their clients really address the market and decide whether they want to invest or not. So I think there's a lot of momentum with that. And we're still just right at the 10-year compound annual growth rate trend. So it's not like we're massively overvalued. And in the past, the markets have had bubbles that peaked at many multiples of the fair value at the time. One time it was 665%, and that itself was down about 60% from the previous bubble peak. So if you then had the next bubble be 60% lower than that bubble, and you extrapolated it out, I think it's 1,446 days from the previous peak has been the gap between peaks. That would have Bitcoin peaking at $320,000 on New Year's Day of next year. So that's absolutely not a prediction, but I'm just, if someone's looking for, whether we're at the end of this bull market, I don't think so. Obviously, it's been a good run since last March when it and all the other risk assets hit their lows, but it doesn't feel like we're at the end of a, it doesn't feel like a bubble at the moment. And there's a question between the returns on venture and tokens. It has historically been true that tokens have outperformed venture. That makes some sense. Tokens have a lot more volatility. So, maybe on a risk-adjusted basis, their returns are lower. But in absolute terms, venture has typically, been a bit lower return, possibly because it's also, a bit lower risk. As Paul said, our loss ratio is actually amazing. We've made money on the majority of our venture investments over 8 years, which is, certainly not true in any normal any normal venture space where 2/3 of the companies go broke. And I want to give Paul and Joey just a second if they have any questions they want to answer. Yeah, so I think we have gotten everything. Thank you all for participating. As I mentioned, we're going to have our first close on June 30th. If you want to participate, shoot us an email at ir@panteracapital.com. Thank you so much.